fellow FIers, welcome to the third episode of the Retirement Police Most Wanted. That's right, we're in season 1, episode 3 already. And today we have a big reveal. We are 99 months away in our 100-month countdown to achieve financial independence. And our big reveal is that we're going to discuss our 2-part FI strategy from age 59 and a half and beyond. So thanks for joining us today. Please make sure you subscribe. We appreciate you sticking with us. We know it's only going to get better and better as we detail our great escape from the Golden Handcuffs. Thank you and enjoy the episode. My fellow FIers, I'm here today to talk about something I've referred to previously, but it's how we are excited to secure our 2-part FI number for age 59 and a half and beyond. Financial independence, FI, and these possible retirement actions in 2 parts. We have a part 1 that we consider to be from age 59 and a half to age 65. And then we view things as a part 2 from age 65 and beyond. And I want to make it clear at the outset that this 2-part strategy is unique to our situation. This plan is what is psychologically comforting for us. We are definitely aware that our 2-part plan does not align with traditional retirement strategies. I'm sharing this because personal finance is personal. Your FI number is also really a very personal, or it should be, based on your situation and desired goals. Our goal, as I've stated here before, is to elude the retirement police, a nod to the internet retirement police, that Mr. Money Mustache, MMM, Miss 1500, Mrs. 1500, or made jokes about the retirement police, and occasionally you'll hear sirens in the distance when we do these secret recordings, and we are very aware that the retirement police are out there, and we are, as I said, looking to elude them by making paid work optional. I'm not aware of anyone else that has a 2-part strategy like this, that what I am talking about today or in any previous episode, there's a disclaimer, right? This is not intended to be investment or life advice. You should definitely consult with your own legal, financial, accounting specialists, your spiritual and or life coaches, all of these people in your network to provide insight to you on your personal and specific situation, because each situation is different and situation is unique. And so really what we're doing here is just for entertainment purposes and to share with you our journey. We have these 2 parts. It's a concept that we have been thinking about for the past several months, sort of these 2 time periods, time buckets that have gained traction. We tend to begin paid work optional, or what some would consider retirement, at age 59 and a half. Once we reach age 59 and a half, we'll have access to our pre-tax retirement accounts. Things like 401k, 403b, thrift savings accounts, those types of things. And again, I don't know if you heard the sirens just go by, but those are the retirement police in hot pursuit of someone. Age 59 and a half to age 65. This will be before we have access to health care under Medicare. Assuming Medicare remains as we know it, I don't think that Medicare eligibility is going to change anytime soon. Currently, Medicare eligibility begins at age 65. 2025 is a year that the federal government, Congress, is looking at the tax bill, the rewriting of the 2017 Tax Cut and Jobs Act. There are provisions in there that are related to the ACA, Affordable Care Act, that extended the credits. Many of you in the FI community are already using them or are aware of these. It's unclear if those provisions are going to be extended. I would think that the incoming administration and the incoming Congress are not so excited about extending some of those things, but there's very, very narrow majorities, and you never know if you have to cut a deal. So the tax bill is something we're going to be watching very closely, as I'm sure the FI community is in general. As we think of assumptions regarding our Part 1 FI number from age 59 and a half to age 65, again, this is based on our ability to access pre-tax and even post-tax accounts at age 59 and a half. We also are assuming at this point that the federal government doesn't plan to modify the age eligibility to access pre- and post-tax retirement accounts. My father, he had funds that were pre-1986, which was a major tax bill under President Reagan and the things that Congress did. And so within his retirement portfolio, there were things that literally said pre-1986 funds. And then there was a separation, 1986 and later funds, given the changes in the law. We're operating under current situation, but we'll see. So we also like to classify certain sources of money within these accounts, and I will go through and describe what we're putting in our Part 1 and our Part 2 sources or buckets of money. So our Part 1 plan is built on cash-like accounts. It's our intention to control our tax situation as we do this. Those smaller accounts will pull the cash out, and then to the extent that we can convert any of our pre-tax retirements into Roth IRA accounts. The Mad Scientist, who's part of the FIRE movement, he has an article that really brilliantly outlines the Roth conversion strategy. In his example, he's actually doing it to access the funds before age 59 and a half, whereas admittedly, we are seeking to utilize the funds after age 59 and a half. We're also assuming the 5-year waiting period then to meet the requirements of the access to the Roth IRA. Why would we do this? Deep within me is a plan to build inheritance for our children from tax-free Roth IRA accounts. We know that unfortunately, given current law, our children could not roll over in an inherited Roth IRA into their own Roth IRA. We also know that under the Secure 2.0 law that you're going to have to withdraw any inheritance down, as it stands right now, over a 10-year period. Anyone who passed away before Secure 2.0 had the ability, if they still have an inherited account from a death pre-Secure 2.0, they have the ability to do the regular, longer-term required minimum distributions. We want to make sure that those funds, if at all possible, are in Roth accounts so that it's after tax, so that they don't have this forced burden of withdrawing in that 10-year period, which could really change the tax brackets that they're in, such that the government would benefit more than our heirs. We've already been trying to incentivize our children to have their own Roth IRAs, but this is just something we're looking to do. I talked about previous episode having access to health insurance. A key aspect of our plan is to ensure that we still have access to health insurance during age 59 and a half to the age 65. Again, we're making certain assumptions. We're assuming that Medicare eligibility remains starting at age 65, or that there's access to the Affordable Care Act with the potential for tax credits, which would certainly be another reason why we'd want to control our taxable income within those brackets. There may be a time period eligible to continue healthcare coverage via an employer plan, albeit at a much higher cost, either through COBRA or certain retiree benefits through one of our employers if we qualify. So to us, going without insurance is not an option that we're willing to consider. Again, these Part 1 funds, I can't stress enough our desire to control the taxable income. We're hopeful that there will remain lower level tax brackets, and that we would want to do everything possible to fall below those lower level tax brackets. We know that there's sometimes a misunderstanding that you are taxed at a rate within that tax bracket. So let's say you're in the 12% tax bracket, you're taxed at that level. Then anything over and above that dollar amount, you're taxed at the higher tax level. But we're trying to maximize the amount of withdrawal that we would take under that 12% tax rate, and then minimize anything sort of over and above that. So probably go into that more in the future, and a little further on drawing down these funds from our pre-tax retirement accounts to control the taxable income as it relates to our future required minimum distributions. So per the IRS, required minimum distributions, and this was as of March 2023, their minimum amounts that an IRA, individual retirement account, and retirement plan account owners generally must withdraw annually starting with the year they reach age 72. 73 if you reach age 72 after December 31st, 2022. So we would, and then the starting age for RMDs is age 75 for those who turn 74 after December 31st, 2032. IRS further goes on to state here, you can delay RMD payments until the year you retire unless they're a 5% owner of the business sponsoring the plan. Owners of traditional IRA, SEP, and simple IRA accounts must begin taking RMDs once the account holder is age 72, 73 if you reach age 72 after December 31st, 2022, even if they're retired. If we delay RMDs until age 75, it will likely place us in a higher tax bracket because we know our Part 2 funds would continue to grow, and that's why we want to utilize the Roth conversion ladder at age 59 and a half. So we believe that that's likely to make our longer term required minimum distribution payments more tax advantageous. We also know that we're going to have significant levels of spending. Some people refer to these as the go-go years. We intend for age 59 and a half to age 65, hopefully a lot longer, to be filled with lots of travel and doing enjoyable things as long as we can. Again, it may be financially stupid to have so much money in cash-like options, but we're building in a guard against market downturns, because really we view this as we're in a race against our physical and mental capabilities. We would like to think that and we will be super active and great shape in our 60s, 70s, 80s, and even in our 90s, but the odds may not be in our favor. And really, one thing that we learned during COVID, it affected a lot of people. That's why we've seen so much demand for travel. The COVID pandemic significantly hindered our ability for several years to take international and domestic trips. We don't want to be held back by the question of whether or not can we afford this financially, when based on life factors, we cannot afford to go and do what we want to do. And that has really been another big driver why, as I mentioned in the first episode, why we are spending more now in these next 100 months than we have in previous years, because COVID has really changed our money psychology on that. Shifting to our assumptions regarding our Part 2 FI number based on age 65 and beyond, the sources of funding for our paid work optional Part 2 are based on a traditional 4% rule. And again, we know it's not a rule. We know Bill Bengen, it's a guide. We know Bill Bengen is revising that number from 4% closer to 5%. Our funding for our Part 2 FI number is based on utilizing our pre-tax retirement accounts, are going to make withdrawals from our traditional 401k, 403b. We know that we're going to need to pay taxes on these withdrawals, as mentioned earlier, depending on how the tax laws shake out or what they are at the time. We may find it advantageous to take out funds earlier than the required minimum distribution rate. We also have, as I said, Roth IRA accounts. For us, they're part of a ladder strategy, how people do things like laddering CDs, a staggering strategy in concert with shifting funds from pre-tax retirement accounts over to Roth IRAs. One thing that we've been trying to dial in but is unclear at this point is what our true annual spending is. We still are at an age where we have costs associated with kids pursuing higher education, and so our number is not dialed into the point. Plus there's some other expenses, so we know we're not totally locked in that, and we want the flexibility to withdraw funds from our Roth IRA based upon our true spending needs, which, as I mentioned earlier, we're viewing these more as insurance or an emergency fund. We think it's a wild card Social Security funds. Time we would reach age 59 and a half, we'll be close to fulfilling 35 years of working eligibility requirements related to Social Security in terms of having that full stack of the 35 years. We know you can get it if you have a much smaller number of years. People believe Social Security will be there in some form at some point. Congress, the president, they're going to have to deal with a future fiscal cliff. Probably not likely to do that until they absolutely need to do so. There are certainly some members of Congress that are motivated to do that now, but how that looks within the next 100 months, we don't know. So since there's no certainty on how Social Security will be structured in the future, we think it best not to factor into our FI calculations. Whether we take Social Security early at a reduced rate, if that's still possible at the age of 62 or delay taking Social Security until full retirement age, which is currently age 67, it will be, in our consideration, an added bonus to our FI number. We also, it's odd to discuss this in some ways, pension payments. Each of us, my spouse and I, would be eligible for a extremely small pension payment. And the reason I say it's odd to discuss this is because pensions are really and have become a rare breed in the era of 401ks and 403bs and things like that. But we each worked for a very short period of time for organizations that offered a pension. In each case, we think that these funds are going to total less than $100 a month per pension. And so it's not really a major factor one way or another what those dollar amounts are going to be. So that's not something we're really banking on in terms of our calculation. Under our Part 2 FI number, we assume that all of our Part 1 funds have been spent down. I'll acknowledge here that it's possible this will not be the case if we continue to work one more year, which would mean we would not spend all 5.5 years worth of savings in, say, 4.5 years. Additionally, again, we assumed that there was no gains in those Part 1 funds. So if there are some Part 1 gains, those would be an added bonus. We admit this is probably a strange plan within the FI community, but it meets our needs financially and psychologically. One thing that I will say, because we've done it on so many things related to finances over the course of our lives, is we reserve the right to change course. Any changes that we make to this plan, we will outline for you in the future to help keep us accountable. But this is what we're thinking about as we're making this journey. With that, we will call it a day. And thank you for listening. Please hit subscribe. Please tell other FIers or others that you know are not aware of FI and want to help educate them in this process. So thanks for your support. Take care.